Good afternoon, everybody. My name is Gareth Petsch, and I run Citibank's Healthcare Specialty Group, which is a division of the Commercial Bank. So we're going to get a little bit more granular than kind of what a lot of the speakers have spoken about today. But while we set up the slides, my team is a national-based team. I'm headquartered in Washington, D.C., but we have specialty bankers spread out throughout the country. And we work in the middle market space of healthcare. And what that means is we like to think our clients are somewhere between emerging to mid-corporate size. Some of our clients are entering to an MSO for the very first time. Some of them are very high growth physician practice groups. This presentation is really put together to answer the type of questions that we get a lot from our clients around, should I go private equity? Should I grow through leveraging bank debt? What are the ups and downs, and why would one be better than the other? And so that's really the topic of discussion today, and we're going to talk about that for a couple minutes. So we're seeing, much like you've heard from many speakers today, an enormous amount of consolidation happening in medical space. We're also seeing a lot in dental. Believe it or not, dental is actually consolidating pretty quickly as well. But what is happening with this consolidation is, as companies tend to need growth to scale, access to capital becomes a much more important issue and plays a bigger role as entities merge, join forces, and grow and acquire. And so with that, larger amounts of capital need to come into the market as consolidation continues to expand. And this leads me to, a lot of times clients grow beyond their local bank needs, and they have to start thinking about secondary sources of payment or access to capital. And that's where that first time decision for a lot of clients to enter into either a debt transaction or a private equity transaction becomes quite relevant for a lot of folks. These types of conversations come in various different types and structures. You'll see not all transactions are considered equal. We like to say there's no one size fits all, because every transaction and every client is unique in their own special ways. And I think that's going to be the key message you'll hear from me, and I think you heard it from a couple others as well. As you think about partnering with a debt or a capital provider, having someone who understands the industry, having someone who can tailor a specific product or specific structure to the needs of the organization is going to be extremely important. And that sort of tailors into the next question about expertise, right? A lot of the reason why some of these roll-ups and MSOs are seeing significant success is as a result of industry expertise. And we'll talk about that as well, and making sure that the person you're partnering with, or the firm that you're partnering with, is both aligned with you from a financial perspective as well as a cultural perspective, right? And it's extremely critical to think through that. So we're going to talk just a couple minutes about the difference between traditional debt, some benefits, and some points to consider. I know there's a lot of private equity people in this room. I am not an equity person. I'm a debt person. I'm going to do my very best not to offend any of the equity people here. So forgive me for that, but I try to be very non-biased here. So I'm going to show you the good, bad, the ugly of both sides. And I think certainly some of the physicians and folks entering into this for the first time will find this really relevant. So the pros of going debt, right? This question, as I said, clients are sort of faced with on a regular basis to say, well, why would I choose debt versus equity? And so generally speaking, debt is going to be able to allow the owners and the decision makers to retain control, right? I think there's a big portion, especially in the emerging MSO space, where control is still a very big issue, right? They're not necessarily ready to give up those board seats or sell a majority share of equity to raise the level of capital. Generally speaking, debt is kind of the first place a lot of these high growth MSOs and medical companies look to until they reach sort of a little bit more size and scale. Although private equity is coming down market, we've seen some interesting trends as to doing smaller deals than you would have ever thought a private equity firm to do. But generally speaking, debt is the first place a lot of folks turn to when it's to think about growth. The nice thing about debt is when you're paid off and the debt's gone, you have no further obligations other than a handshake to your banker, thank them for their work, and you're done. You never have to really worry about that again. often touted as one of the most cost-effective ways to access capital. Certainly going to be a lot cheaper than giving up a piece of equity, which has an unknown value, right? And a piece of equity is only as valuable as someone's willing to pay for it, which 1% of equity could be worth $1, it could be worth $100,000, could be worth $1 million. It just depends on the market and the conditions that under which when you're choosing to sell. So there's some downsides to debt, right? And I wouldn't be a good banker if I didn't tell you what those look like. So probably the biggest thing with debt is the scheduled payments, right? The payments generally start immediately following any debt transaction, right? Whether that be a small or large or larger, sort of public-related debt. The bank's going to want covenants. They're going to want to make sure that the performance of the institution and the firm continues to stay strong, and they're going to monitor those covenants to make sure that you're not taking too much money out of the company, the owners aren't sort of overspending. They're going to want to see positive trends, although not quite as aggressive as some financial partners might be. On the lower end of the market, as you think about the emerging folks that are still physician-owned or potentially entering into their very first MSO or HSO, as we like to call them, healthcare support organization, a lot of times banks are going to think about personal guarantees. So especially if our doctors are still seeing patients and they're also the major equity owners, or at least the majority of the people making the primary decisions at the lower end of the market banks are generally going to want a personal guarantee to make sure that your key stakeholders still have some skin in the game. And a big one that we face a lot with our clients is generally as you're progressing, especially in a high growth environment where there's a lot of M&A, a lot of these clients are coming to us with very low quality financial statements, right? And that's going to be a painful experience for most emerging healthcare companies. Generally speaking, they're managed on a cash basis. They're using QuickBooks in their office, and they've never really had to work with a large-scale commercial bank or corporate bank. And so what we try to educate our clients on is say, look, whether you need it now, whether you need it in 3 years, upgrade your quality of your financials, upgrade your accounting systems, because whether it's debt or equity, the sooner you can get to an audited level of financial statements, the better you're going to be, and the higher quality of the interactions you're going to have with your banking and finance partners is going to be especially of importance. So that's some of the downsides and the upsides of debt, right? There's obviously many more. But let's do that same exercise now for the private equity side, right? So let's think about if you're a young MSO looking at this option. So benefits of going the equity route versus the debt route. For the most part, private equity players are going to be a little bit more aggressive in terms of the amounts of capital they're looking to place. The multiples of EBITDA, if you go to any medical conference today, 10 years ago when I was going to medical conferences, EBITDA wasn't even a word that anybody knew what it was generally, right? It was always, how do you sell your practice and what are you guys doing clinically? Whereas today, EBITDA has become a much bigger thing, and doctors and owners of MSOs and practices are starting to think about that as the lifeblood of why they do what they do. So, generally speaking, the amount of turns of EBITDA a private equity firm is going to be able to put onto the balance sheet is going to be a much higher amount than, say, a bank would, right? Remember, and in return for that, though, they're taking a big chunk of the equity in some cases. Another advantage is a lot of private equity firms have done this many times. They've got a lot of experience dealing with roll-ups and scaling organizations, so they bring a large depth of knowledge and leadership and partners to help generally unsophisticated organizations become sophisticated and bring in M&A expertise, and it'll augment that with the clinical expertise that these companies have. Sometimes, not all cases, speed to get to the funding table is generally a little bit faster, but again, not in all cases. We're also seeing some really interesting structures with private equity. In the old days, it was, we'll come in with a bunch of capital, we'll do a leveraged buyout, and we'll take up 80% of your equity. But we're also seeing some now interesting structures when it comes to mezz debt, minority positions, deferred debt, all sorts of other things that have become very creative to help companies achieve the growth that they need to achieve while not constraining the ability to grow. Most of the private equity firms we've seen in the space look for about a 5-year time horizon before they start thinking about what's their exit strategy. Some are longer, some are shorter, depending on the groups that you work with. And we've also seen some really nice financial incentives being built into some of the contracts with the physicians, allowing them to take money off the table immediately, take a little bit later, and then based on performance down the road, they can actually earn more money, right? Because when the incentives align, the private equity firm obviously wants to return their equity, right? So they want the practices and the business to continue to grow and continue to see that escalating EBITDA. Some of the things to consider for clients thinking about equity on the maybe not so great side is dilution of ownership. For the most part, private equity firms and other equity investors are going to want a piece of the business. Usually it's a majority stake, 51% or more, or in some cases a minority stake, but they want some sort of control of the board or a number of board seats. And when that transaction occurs is almost as important as to why that transaction occurs. A lot of our clients are at the very young stage, calling it 3, 4, 5, 6 million of EBITDA, and they're bringing in private equity firms and raising capital for their next round of growth. But if they had options to maybe delay that by a year or two, that transaction would be much more valuable because they have more scale, they have more size and scope. So when that happens is also important as to who and why. A lot of times you have to think about the incentives and do they align with the fundamental mission of what the organization is about. You heard from Citi MD this morning, there are 4 pillars. You've heard culture, you've heard a lot of things. So does your financial partner align with your best interests, right? Remember why, as a physician anyway, why you got into this business. It's not for EBITDA, it's not for this, it's to care for patients. And so oftentimes, right, when you think about the major mission of any financial institution, whether it be a capital provider of debt or equity, it's to return capital, right? That's basically the bottom line. So do the incentives align and does the culture align is extremely important. Where we've seen deals go sideways is when you have differing views, right? Priorities are different, culture is different, and partnerships tend to break after the initial check has been sent, right? Because generally sellers forget about that large check after a certain number of years. We've also seen some interesting things with very highly leveraged companies. Some private equity firms will come in and offer a very large initial investment, but the actual cash outlay is relatively small. And so some of these companies are seeing an enormous amount of debt being placed on the books in terms of senior and junior debt and mezz debt. And it sometimes inhibits their ability to continue to grow. With cases like, you're coming in and let's just use round numbers, right? $100 million buy-in, and we're going to put 30 million of cash in and 60 million of debt. Has your company ever managed $60 million of debt? Can you afford to pay back $60 million of debt? And are you able to think through that leverage? We've seen cases where CFOs have resigned as a result of an equity transaction because they aren't able to access fresh capital to grow their business and need, because no bank's willing to go to the level of debt that they're currently at. So just important things to think about as you are interviewing a bank versus a private equity partner. And then the final piece on this side is the projections, right? Are they realistic? Are you able to achieve what the firm is forecasting for you? Again, the primary driver of any capital investor is getting their money back. And especially as you're seeing some of these crazy multiples, the only way that you're going to get that money back or that they're going to get their investment back is by excessive growth or really aggressive growth. And so in some cases, is that really sustainable, achievable for you as an owner of an MSO or as your C-suite as an MSO? Is that realistic for what you're able to integrate? Remember, you've got to integrate. You can buy as many places as you want, but can you successfully integrate those into your operations? So in summary of what we talked about, I think a couple of key takeaways I would recommend, and a lot of advice we give to our clients is around focus on what you do best, right? Run your medical practice, run your patient treatment, and that's got to be your core focus. Don't lose sight of what it is that what your mission is. It's not a one-size-fits-all approach, and I've looked at thousands of transactions, and every single one of them is different. Yes, they have general, characteristics that are the same. But when you choose an institution or a firm, you've got to be able to be with a place that can custom build and tailor a solution that's bespoke for your organization. And I think that comes from the underlying understanding that the institution that you choose has to understand your industry, right? I think if you were to look on Google, there's thousands and thousands of institutions that are throwing money into healthcare. Question how many healthcare deals have they done? What's their track record? Who are their clients? What type of success are they seeing? And because if you get into a relationship with a partner, whether it be a bank or an equity firm, it's generally a long-term relationship, and it can be very detrimental if they don't understand your business. They don't understand how to cash flow a deal. They don't understand the nuances of being in the healthcare space. Depending on your life cycle, right, what's the best capital structure that best suits you and your management team or your ownership team? It's not always the simplest solution, right? In some cases, PE is better. In some cases, debt is better. So think through that as you age and what's your goal as a vision as to a 5, 10, 15-year plan. And again, culture, right? Make sure that the people that you're working with have the similar mindset to you and your organization. I can't tell you how important that is because, again, long-term relationship, do you have the same vision and the same strategy? And are you able to get along with these people, right? Especially if you're going to have a board seat or two and your vision is sort of bifurcated into two different paths. It can be a very tricky and troubling situation. So that's really all I wanted to cover today. I'll have, I guess, a couple minutes left for any questions in the room. I know it's not an interesting shift from the Goldman guys this morning where they're talking about their transactions with Bs. Mine start with M's. So any questions in the room?
Yeah, I'm just curious to know what kind of fees. So both for debt, which I would imagine is going to be considerably lower than equity, but yeah, so for either cap raises or some of the advisory work, any info on fees would be useful. And then I guess one other question related is, what are you finding in terms of MSOs going to market with a transaction? Are they typically making the rounds themselves direct to investors, or are they engaging an intermediary to help them?
Yeah, so two great questions. So with the first, I can't really speak to the PE side. I'm not an investment banker. I'm a lender, corporate lending person. So generally, fees and costs are going to vary widely. If you compared this kind of lending to, I'm just speaking to the lending side. I'm not going to try to pretend I'm an investment banker. If you are used to borrowing at a mortgage level or commercial real estate or individual mortgage, this is going to be more expensive than that. Right? Generally, banks that lend into the healthcare space understand that these are relatively unsecured loans, right? There isn't much collateral. We can't come in and take ownership of the medical equipment, which is technically worthless for anyone outside of a doctor. So there is a slightly elevated cost, but most of the commercial banks, it's more about speed to execution and structure, and cost is secondary. But you're still going to be at a regular sort of commercial bank pricing. So anywhere from 0.5 point to a point on the front end when you fund a transaction, and cost of capital is varying degrees of whether it's LIBOR based or prime based or fixed cost. It's going to be around commercial paper. A 10-year T-bill generally is about where you go, but it varies widely based on the structures. I'm sorry, remind me of the next question. I forgot.
Whether MSOs are going to market direct.
Oh, yes, sorry. So that question also, it depends, right? What we see, again, because we deal with a lot of emerging MSOs, we also have some medium-sized ones. The younger MSOs, and I mean younger by size, generally are doing it themselves. They're still heavily connected to the market. There's still doctors that are heavily involved in the day-to-day running of the show, and they're connected to the people in the industry through med school, through networking events, and they're doing this themselves with the help of professional advisors, like some of the law firms in their group, the accounting firms, and the bankers. So I think that's where we're seeing a lot of it on the younger side of the MSO. There's also a lot of activity at conferences and things like that. And as you go up market, I think the investment banking side of it, you're seeing them starting to come in at a much higher size of the company. My team works, generally speaking, up to companies about $250 million in size. So most of our clients aren't going to market yet, but as they get bigger than that, they are. I will say, though, we're seeing a lot more activity coming down market, where the investment bankers at one point wanted only $100 million EBITDA companies and up, but now they're starting to come down market to the 50, 35, 45 million because the multiples and the activity is so, what was the word used today? Frothy. Yeah.
Hi, just a couple of questions. First is, can you give us a sense for the size of transactions that you typically get involved? So how small do you go and where do you top out? That's kind of the first one. And then the other one is, just walk us a little bit. If you were thinking about a practice or an MSO that approaches you, what kind of financial metrics or what is it that you're looking at to decide how much debt goes into that business? And then can you tell us a little bit about the terms of the debt? You know, what the leverage is that you basically are projecting, what's the maturity, you know, any type of covenants that it would have. I think you spoke a little bit about the cost, but, you know, is it, any of that would be helpful just to give us some sense.
Yeah, absolutely. Citi, my firm, generally we start lending at, I'd say on the low end, around 3 to 4 million. That's where our starting point is. So we do go pretty low when it comes to sort of the young emerging companies. On the high end, most of our clients, I'd say we funded a $100 million transaction. But I would say my average client borrows anywhere from 15 to 40 million. So this is, generally speaking, clients with 15 to 20 locations or around $50 million in revenue. Metrics, I know I'm running short on time, so I'll kind of cut through this quickly. Metrics in deciding why we lend money is extremely not a science versus an art, right? 50% of the reason why we say yes to a loan is the strategy, the management team, and the people. The financial metrics are also very, very important, but if we're not comfortable with the management team and we don't think that they can execute on their plan, we're not going to make the loan no matter how profitable you are. Because most of the reason these companies either succeed or fail is integration. You can go out and buy as many practices or many locations or do as many de novos as you want, but if you don't know how to integrate them and centralize and actually create the economies of scale, are you managing a group of practices or are you managing a group practice? So that's the key, but generally leverage, terms, covenants, banks are going to want to look at a debt service coverage covenant. So for every dollar in debt payments, they're going to want either $1.15, $1.20, $1.25 of free available cash flow to service that particular debt. And then terms are going to be anywhere from 2 years to 5 years to 7 or 10 for acquisition type facilities. And clients sometimes want to purchase real estate as well. Covenants are going to be leverage and debt service are the two main ones. Banks generally are going to keep it much lower than what an equity firm might. We're going to keep leverage around 4 turns of equity, 4 turns of EBITDA, sorry. And the covenants, depending on the structure of your financial statements, pre and post distribution, we want to make sure you're going to stay in those guardrails before you take the money out and then again after. So I think I'm out of time. I'm getting the hook here. So I'll be around the rest of the day if anyone wants to grab me. But thank you so much for having me. I really enjoyed it.